Hello, all you lovely people out there. How are you doing? I'm Kate Hill, and I am here to give you the best unbiased, honest commentary about our property markets. Today, I am talking to Tina Howes from SmartMove again, one of Australia's leading and award-winning mortgage brokers. There's been some developments this week in banking and finance world, so we just wanted to give you an update. So stay tuned. Hello, Tina.
Hi, Kate.
Hello again. At the end of our very recent chat, you mentioned something about APRA and their fact that they might be tinkering with lending standards in the near future. There were mutterings in the background, and this has in fact now happened. So we thought that we would have a little chat to update everyone on what has happened. So Tina, explain to all the lovely people, who are APRA and what do they do and what exactly is it that's happened?
Okay, thanks, Kate. It was only a week ago that we had our chat.
Yeah.
And then I think the minute we finished it, we've had the media go crazy about, the DTI and assessment rates and house prices. But essentially, the banks are all regulated by a body called APRA. Ask me exactly what that acronym, Australian Prudential Regulatory Authority. It's a mouthful.
Yeah.
But essentially, they're there to govern the banks and to ensure that the lending guidelines are kept in check, and ultimately to ensure that we don't have cowboy lending and unstable, anything that could potentially risk our economy.
A subprime mortgage crisis. Yes.
Yeah. Yeah, absolutely. We learned from the GFC and we don't want to have one of those ever again. So what's been going through the media is, a few of the stats that by the end of this year, we're expecting to see property prices, particularly in Canberra and Sydney and one other state, I'm not Victoria perhaps, increase by 20%. But we're only seeing an increase in wages by about 2%. When you have that kind of property growth without that income growth, then essentially you see this disparity and a creep in of unaffordability, just making it harder and harder and harder for people to be able to borrow. So one of the mechanisms that they were talking about implementing is a debt to income ratio. Now that's already been brought in whereby some lenders won't exceed a certain limit, and that's typically around 6 times. Other lenders will go up higher, but potentially not for certain types of clientele.
And sorry, love, just to clarify for everyone out there, so that literally means borrowing 6 times or more than their annual income?
So let me break that down. So it is simple as your level of debt to income. So if you borrowed $1 million, divide that by your combined income. So that would be your PAYG income, or if you were self-employed, it would be your PAYG plus your profits, plus your rental income. That debt figure is not just your mortgages, but it includes things like credit cards, car loans, and so forth. So capping that out at 6 times, some lenders at 7 times. I think there is an overarching cap at 9 times, 10 times. But there's been more leniency amongst investors because with an investor, it can explain why that debt to income ratio is higher than, say, an average person that doesn't have that additional income stream. So having said that, there's been article upon article about bringing in this DTI. Every bank business part that I talk to is, concerned about what implementation, what will come out of this. And then this morning, in fact, probably on the back of the Reserve Bank yesterday, keeping interest rates on hold, making more whispers about it, they've essentially decided to increase the assessment rate, and I'll explain that in a second, rather than playing with the DTI measure. Okay?
Which is that debt to income, DTI, debt to income, just so everybody
knows.
The acronyms, yes.
Acronyms, yes. It's a thing us bankers and brokers use a lot of. So assessment rate, there's no acronym for that one. But essentially, if you apply for a loan and we look through at the servicing capacity is essentially how much you can afford to borrow when you input those numbers into a bank's calculator.
Yeah.
If the interest rate is 2.5% or 3.5%, the bank doesn't simply use that actual repayment.
Yeah.
It will use an overarching assessment rate,
yeah,
which is a higher rate than the actual interest rate.
Yes.
And that is the rate that is used to assess your loan repayments at a higher rate in the event that interest rates go up. Okay. Now, until recently, there's been a cap at, say, 2.5% over the actual rate. That's now being increased to 3%.
Yeah. So it's gone up.
It's gone up. Yeah. So what that means is a slight downward movement in how much you can borrow. Yeah. And it's as simple as that.
Yes.
So my advice to people out there, if you're an existing client, it won't impact you. If you've had a loan for more than 2 years, chances are the assessment rate was even greater than that. It could have been up at 6.5%.
Yes, that's right.
Or even 7.25% not that long ago.
Yes.
Okay.
That's right.
But my advice would be, if you are already pre-approved, now we'll know more of this in the next couple of days. However, historically, when APRA make these changes, the bank then essentially comes out with a new servicing calculator, whereby and a guideline that says you need to add this much over the actual interest rate.
Yeah.
But that'll take a little bit of time to work through the system, but it could be as soon as Friday that we see the bank, because the banks essentially know that this is coming.
Yeah.
So we start to see new servicing calculators come out from the banks.
Yes.
And so impacts on anybody that's, in that process of having an application put to a bank.
Yeah. Okay. So in terms of what this actually means for the common borrower out there, is that literally just means they will be able to borrow slightly less.
Yeah. So if you're someone that's at your absolute upper end of borrowing capacity, this will potentially reduce that by 5%, 10%, depending. It's always a function of how much you're borrowing. If you're out there borrowing and you're not at the absolute upper end of your borrowing capacity, probably no impact on you whatsoever.
Yes.
If you have a pre-approval with a certain lender that already decided to have a higher assessment rate, then potentially no change whatsoever. But I do want to mention that point, that in the past, if you have a pre-approval and that pre-approval is valid for 3 months, there's potentially no change to you for that period while your pre-approval is valid.
Yeah.
It would be most unusual for the lenders to turn around and pull their existing pre-approvals and say, no, sorry, now you've got to use a revised servicing calculator. That would be a disaster. You just think of all the people that have gone to auction trying to go from pre-app to formal. So I don't expect to see that.
Yeah.
But if you have been pre-approved, you're coming to the end of it, and you haven't managed to save up more money during your pre-approval period, then potentially when you're looking to extend that pre-approval or go for another pre-approval, there could be a downward movement on that.
Yeah. Yes. Okay.
Reach out to your bank or to your broker, see if it impacts on you, and potentially look at what that level looks like.
Yeah. And do you foresee any differences in how this new directive, if you like, will affect owner-occupiers versus investors, or equal? No,
it's too soon, I think, to know. Yeah. But the thing with the assessment rate, typically if you're an investor, the interest rate's higher than an owner-occupier. And so, that floor will impact more greatly. But I think it will just depend on how the banks choose to adopt the rules. And it's only literally come out this morning. So it is a bit of a watch this space. But I think it was important for us to give this update, given just the sheer attention and the volume in phone calls that I've been getting, my colleagues and yourself as well. So
yes.
Don't panic. But if you've had your numbers done, then it's probably worth sort of rechecking those.
And I think it's interesting. I mean, just in the interest of keeping this shorter, we could talk about the wisdom behind these kind of decisions for the rest of the day. But I think, there are probably other ways to take the heat out of the housing market. But such is life. This is what they've decided to do. So like you say, just watch this space. Don't panic.
Yeah, it's definitely, from my perspective, definitely preferable than a debt to income ratio cap. Doing numbers for 2 different scenarios for clients, saying if it's a 6 times debt to income, your number stops here. Whereas now it's actually, I can increase the assessment rate and there's not much of a change for you at all. We can close that credit card or pay out that $20,000 car lease. So those sorts of things.
So it seems to be a relatively, dare we say, minor intervention.
It's a softer intervention, absolutely, than DTIs.
And I guess that will be
there's out there that we're doing 8 times, 9 times.
Yes, and like you say, a bit of a watch and wait to see what else might happen. We are coming out of lockdown in 2 of our bigger cities in Australia, which I think will make a big difference to listing numbers. And of course, what I think, remember people, that all of this is supply and demand, right? So
absolutely.
So the moment there is more supply, the moment the heat comes out of the market, so because we all have a bigger choice of properties. So I think giving people confidence in the fact that we are coming out of lockdown, the fact that there will be more listings. It's typically spring. Everyone wants to get settled and bought and sold before Christmas. So I think, I think there's an argument for this may have eased anyway without their intervention. But anyway, that's just my opinion.
We will see.
We'll see.
Yeah.
Thank you, Tina.
Thanks, Kate.
Brilliant. Great. We'll give you all another update when there is more to tell you, basically, won't we? All right.
Cool.
See you all soon.
Bye.